The markets continued their downward trend, with the Dow opening lower and trading below the 50-day moving average. It was already in a downward trend when it closed below the T-line, with the anticipation that if this was the top of the trend channel, it was likely to come to the bottom of the trend channel, which would equate to about the 200-day moving average. What had been holding up the market trend was the NASDAQ, where it couldn't seem to close below the T-line. The NASDAQ closing above the T-line and the Dow trading below the T-line merely told us that there was specific sectors that were being sold off while other sectors were being bought. However, today's trading not only showed the Dow continue to sell off, but a bearish left-right combo. That's a bearish engulfing signal following kind of a doji day. That's a very strong change of investor sentiment. So if markets open lower tomorrow, anticipate more downside. The only way for the trend to continue is that the NASDAQ opens higher and trades higher during the day, staying above the T-line. Very simple indicators allow the candlestick investor to take advantage of what's going on in investor sentiment based upon where the signals are occurring, such as in August soybeans. Notice the bearish engulfing signal right smack dab on the 50-day moving average in a trend that already looked like it was in a downward trend. So the risk-reward factor was that if this confirmed, meaning if they continued to sell off after the bearish engulfing signal, that was a good indication the 50 was acting as a resistance level. Also, with a close below the T-line after a bearish engulfing signal, told us our likelihood of coming back down to the bottom of the trend channel was good, but doesn't necessarily mean it was going to stop there. As you can see, our simple rule of the T-line is if you see a candlestick sell signal and a close below the T-line, you can stay short until you see a candlestick buy signal and a close above the T-line. As of yet, soybeans are still in a downward trend, making it a very profitable trade. The moving averages are very relevant. Notice that on our recommendation of CWH yesterday with a doji right here off the 50, they gapped it up, your best friend's signal, telling us when they came up to the 50, it acted as resistance. When they gapped it up again, the best friend's signal told us that the 50 was not acting as resistance anymore. The next likely target is the 200-day moving average up in about the $35 range. These patterns work effectively because human nature works the same way time after time, allowing us to identify where the strong trends are starting. Using that technique of just using the simple rules of candlestick analysis based upon hundreds of years of observations, told us that if Cron, C-R-O-N, opened positive today, we wanted to be buying immediately, which it did. And the reason we would suspect that is we had a gap up through the T-line off the 50, telling us the bears were out of the way, the bulls are starting to take control, and that would be further confirmation if they opened positive, doing the simple doji rule, which is the price is usually going to move in the direction of how they open after a doji. This is not rocket science. Investor sentiment works the same way time after time. The Japanese race traders identified that hundreds of years ago. All we have to do is learn how to use it effectively. That'll be it. We'll see you in the chat rooms.